Let me tell you now about two historical stories related to risk management, hedging, caring about reducing risk. And the first one is called portfolio insurance. It's an idea that goes back to the 80s, and that's when it was popular. And it was actually popularized by two professors, now retired professors at Berkeley, Heine Leland and Professor Rubinstein, whose name we heard in this course, Mark Rubinstein, the one from Cox-Ross-Rubinstein binomial tree model. So their idea was, suppose you, and by you I mean a big bank or an institution, you run a big portfolio, maybe say $1 billion or whatever, and you want to be sure that you don't lose more than, let's say, 5% during 1 year. Now, if you could buy a put option on that portfolio, you could guarantee yourself to sell your portfolio, let's say, for 95% of its today's value, so that the strike price is 95% of today's value. Right? So just considering your portfolio as an asset, if you could buy a put option on that, put option is insurance. It's a guarantee that you can sell your portfolio after a year for a pre-specified strike price. That's one way you could do this type of goal. If your goal is not to lose more than 95% of your money, you could just buy the put option. Well, your portfolio of $1 billion, or who knows how much, is a maybe complicated portfolio consisting of many assets, derivatives, who knows what, and there is no put option you can buy on your portfolio. However, in a market which is complete, like Black-Scholes-Merton type market or binomial tree market, you can, in theory, replicate any payoff, including the payoff of the put option. Right? So in theory, you could, using, let's say, Black-Scholes hedging theory, you could trade in the underlying assets of which your portfolio consists. You can trade in those assets so that your final payoff is equal to the put option, or put option plus whatever is remaining in your portfolio, and that way guarantee yourself that you will have at least certain amount of money, a minimum amount of money that your portfolio will keep. And that actually they used, and many companies started using this in the 80s. And for a while it was working relatively well. It became very popular. But then what happened was a crash of the market in October 1987. And what happened to these strategies of replicating a put option? By the way, it's called a synthetic put when you are doing this, replicating a put option by trading in the underlying asset. What happened is, well, if you think about hedging a put option or replicating a put option, we saw for the call option, you have to be long shares of the asset in our hedging example previously. Well, for the put option, you have to sell. Initially, you're going to be short because the put option goes down when the stock goes up. In order to replicate then the put option, you have to sell some of the assets in your portfolio. But when a crash is happening and the prices are going down, that's usually when everybody wants to sell. Yeah? Everybody wants to sell, that pushes the prices down. You also want to sell because that's what your Black-Scholes replicating strategy tells you. So you are selling even more, prices are going down even more, and it's a self-feeding process that then it's hard to stop. Right? So many of those who use this portfolio insurance strategy lost money. In fact, some even claim that because so many people were using the portfolio insurance strategy, it also contributed to the crash. Whether it's true or not, the point is the Black-Scholes-Merton theory obviously has its limits, and this is one of those stories that shows those limits. Simply during a crash, the assumptions behind the Black-Scholes-Merton model are simply not true. You don't have nice normal distribution, nice randomness. The prices are skewed to the low values because they are crashing, they are going down. There may be even less randomness, but it doesn't mean less risk. Everything is moving in the direction south and going down. And your market is definitely not complete, especially if you have a jump. I mentioned, I think, in the jump models that when you have jumps, those models are not complete. So if crash is a jump, when you don't have this usual Black-Scholes-Merton assumptions close to being satisfied in reality, you don't have something close to a complete market, you cannot replicate your payoffs that you, in this case, the put option that you want to replicate. All right, so that's a story about portfolio insurance. It's maybe a good strategy as long as your market is close to being complete. But if it's not complete, or if something bad happens, sudden jump in prices, it's not going to work. That's one story. And then another story with the familiar names in this course. Another kind of bad thing that happened, or it was a good thing for a while and then became bad. Well, good things, happy things are not interesting to tell stories about. What's more interesting is telling stories about bad things that happened. So in the same spirit, that's what we are doing here. And it's the story of long-term capital management, which was a hedge fund, a big one, a very successful one for a while, in which two of the partners were, in fact, Robert Merton and Myron Scholes, and the names we hear a lot in this course. In fact, they received the Nobel Prize like in 1997, and the hedge fund ran into trouble in like 1 year later. So it's an interesting story because you have these famous people who got a Nobel Prize for their work in financial markets, and they ran a big hedge fund. Well, they were two of the partners, there were more partners, and the hedge fund is very successful, and suddenly it got into trouble and almost went bankrupt in the end of the 90s. Well, let me tell you how that happened if you don't know the story. The hedge fund, it wasn't really using so much sophisticated options theory. It was more looking at kind of small opportunities for small profits that looked like approximately arbitrage opportunities, and then throwing a lot of money on these low profit opportunities. But if you throw a lot of money on it, you can actually scale that up and make large profits. For example, they were anticipating their positions were constructed in such a way that they would make profit if the spreads between corporate bonds and the US Treasury and government bonds would go closer to each other. If the spread went narrower and the rates went closer to each other. Because at that time, they were at a historically high spread, high difference between US government bonds and corporate bonds. Now, US government bonds will always pay less interest less yield than corporate bonds, because corporate bonds are more risky. And why would you invest in something which is riskier if you can and pay more if you can just invest in something less risky if it doesn't cost more? So that's why corporate bonds are always less expensive, and meaning have higher yield than the US Treasury bonds. And the difference was so large that long-term capital management, the hedge fund, was basically predicting that they would get closer to each other. And similarly, they also were predicting or projecting that the difference in interest rates in various European countries would get closer to each other. It was the time of euro happening. However, there was one big shock to the market was the Russian crisis. Russia defaulted on its own government bonds, could not or did not pay on its obligations, which created a fear in the market, the uncertainty. People don't know what's going to happen, and then they run to safe assets. And one of the safest assets is US government bonds. And therefore they became even more expensive and paid even less yield because everybody wanted them during uncertain times triggered by the Russian crisis. Okay, so the spreads went even wider, which hurt the position of the LTCM, the long-term capital management. And similarly with these European interest rates of different countries, they didn't go closer to each other, they also went wider from each other. Now, this is not necessarily a problem if you can wait until the crisis passes and spreads do start getting closer to each other. But you have to have a lot of money to be able to survive, to ride out the losses in the meantime. Okay, we already saw this with the example of rolling over short-term futures contracts. Similarly here, the LTCM fund was highly leveraged, meaning that a lot of their money was borrowed. They were invested more than they actually had. And one reason they were able to borrow a lot was in particular because they had famous people like Merton and Scholes on their board. They had a lot of borrowed money, but now they were losing money on their positions and they had to pay margin calls. And the less money you have in your positions, your lenders want to receive some guarantee that you will be able to pay what you borrowed. So some type of margin calls force them to start selling their assets. Because they were so successful, also many other companies had similar positions, so they also had to sell their assets. So prices went even lower. Again, this self-feeding process, and they had huge losses and almost went bankrupt. What happened next was like the first big bailout because they almost went bankrupt. The US government decided they are too big to fail. It was not as big a bailout as in 2008, 2009, but it was the biggest at that time. So what the US government did, they didn't directly bail them out. They organized a meeting of big investment banks in New York, and together they decided it would be too much of a shock to financial markets if long-term capital management goes bankrupt, and they organized a package of loans and contracts so that they would give enough money to long-term capital management to survive and try to recover and not go bankrupt. And that's what happened. They bailed them out. They gave them enough money to survive, and they did survive. And they closed. Then they recovered their losses, and they closed with in good terms a few years later. But if there hadn't been the bailout, they would have gone bankrupt. Okay? So you have this story of really famous and really skillful both academic and practitioners who were partners of this fund, and the fund was doing extremely well. Everybody was looking at them, in fact trying to copy them, and then suddenly the whole thing almost went bankrupt. Well, I'm sure they had their own risk management methods, simulations, scenario analysis, what is going to happen to their position if this happens or that happens. But probably what happened is they did not really have in their scenario analysis the possibilities of this high spreads between US government bonds and corporate bonds, between different interest rates. They just didn't think this could happen because it never happened before, and they were also highly leveraged. So if such a bad thing for them happens, they have to pay a high margin calls, and they may not be able to survive. Right? Similarly, as we saw before in that rolling over futures contracts example. Well, or maybe they did have these moves in their scenario analysis, but didn't put enough probability, significantly large probability on them. In any case, it's a good story. Again, to be always a little bit skeptical about how much you can model the markets and predict where the market is going to go. There will always be surprises, and it's hard to always put the correct probabilities on things that might happen, and especially if you're highly leveraged, if you have a lot of borrowed capital, you have to worry about whether you can survive when bad things happen. There is a kind of an entertaining book called When Genius Failed. It's not a technical book; it's a fun book about this event. So it might be fun to read, although by now this doesn't look as such a big event because we had in 2007, 2008 much bigger crisis, so this is no longer that interesting. Before that, when I was teaching this class, this was like the biggest bad event that happened in the derivatives market and in the financial markets, modern financial markets. But now we also have the bigger story from a few years ago. All right, that's the story about the long-term capital management, and that's it for this set of slides.